Hello dear friends, welcome to the BinaryWins channel. I'm here with the 19th episode of the Candle Psychology video series. In this episode, I'm going to teach you some exciting and important candlestick patterns. We will learn how to identify these patterns and then trade using them. So, stay with me until the end of this interesting video. Well, the first candlestick pattern is the momentum candlestick pattern. The momentum candle is a candlestick with a large body and of course, small shadows. And its dimensions must be at least 3 times the body of the previous candle. With the formation of this candle, after the conditions that I will mention, we can enter a trade in the same direction as the momentum candle on the next candle. But how to identify the momentum candle? When we have a side range and compressed trend, meaning our candles are moving between a support and resistance close to each other, and then a large candle is formed by crossing this range and breaking the levels. We can enter a trade in the same direction as the momentum candle on the next candle. This indicates that the movement is likely to continue. So, this is called a momentum candle, which is one of the good candlestick patterns that, when identified correctly, can help us make good trades. The next pattern is the multiple candles pattern, which is a reversal pattern that usually appears at the end of an uptrend or downtrend. How to identify this pattern? When 3 or more candles form in a straight line with pressure and wicks in the same direction at support or resistance, it is called the multiple candles pattern. This pattern shows that the price movement in one direction has stopped and there is indecision between buyers and sellers. This increases the possibility of a trend reversal. For example, look at this downtrend. After reaching a support level, several candles with pressure and rejection from this level form in a row. So after the first candle that has crossed this straight range is formed, we can enter a higher trade. Similarly, at the end of an uptrend, when several candles are formed in a straight range with pressure and rejection from the level, we wait for the trend to reverse and the first candle to cross this straight range, and then we can enter a lower trade on the next candle. But the next pattern is the tweezer top pattern. This pattern consists of 2 opposite colored candles at the end of an uptrend that have pressure and wicks on one side. But when this pattern forms at resistance, there are 2 possible trading scenarios. If the first candle is green and the second candle is red, there is a high possibility of a trend reversal leading to the formation of a red candle next. But if the first candle is red and the second candle is green, the uptrend may continue, leading to the formation of a green candle next. Look at this example. We have an uptrend. We have two candles of different colors at the end of the trend, both of which have received pressure and rejection from our level. Now we wait. To enter the trade, we use a confirmation. If our third candle receives pressure and rejection from the level or the close price and shadow of the first candle, or if it receives rejection from the upper half of the first candle, then we will enter a lower trade. That is, our third candle must first move up and receive pressure and rejection from the first candle, and then we will enter a lower trade. So this pattern is called the tweezer top pattern. But if it is the opposite, that is, the first candle is red and the second candle is green, we can still enter the trade with confirmation. That is, our third candle must first receive pressure and rejection from the close price or the lower half of the first candle, and then we can enter a higher trade in the same direction as the trend. Okay? But the tweezer bottom pattern is formed at the end of a downtrend and is support when two candles of different colors that have pressure and shadow from the same direction form on the level at the end of a downtrend. It is called a tweezer bottom pattern. In this pattern, if the first candle is red and the second candle is green, there is a possibility of a trend reversal. But if it is the opposite, there is a possibility of a trend continuation. Also, like the previous pattern, we enter the trade with confirmation. That is, we wait. First, the third candle moves downwards, and if it receives pressure and rejection from the close price or the lower half of the first candle, we enter a higher trade on the third candle. But in this pattern, the first candle was green and the second candle was red. We enter a lower trade upon receiving confirmation. That is, pressure and rejection from the close price and the upper half of the first candle. Okay? Bullish Harami and bearish Harami patterns. The Harami patterns are reversal patterns. This form when a smaller candle is completely covered inside the body of the previous larger candle. Note that the body of the larger candle should be at least 3 times the size of this second candle. In downtrend, when a green candle forms inside the previous red candle, it is called a bullish Harami. In an uptrend, when a red candle forms inside the previous green candle, it is called a bearish Harami. For example, look at this downtrend. It has reached a support. As you can see, our second candle is 1/3 of the red candle. But to trade with this pattern, we can also use a confirmation. As you can see, the green candle is formed with a gap and distance from our support or the close price of the first candle. If our third candle first comes down and receives pressure and rejection from the gap, we enter a higher trade. That is, the candle will first receive a rejection from the lower gap and then we will enter the higher trade. This pattern is called the bullish Harami pattern, but the next pattern is the opposite of this pattern and forms at the end of the uptrend. To trade, we wait until our third candlestick first receives pressure and a rejection from the upper gap and then we enter a lower trade. This pattern is called the bearish Harami pattern. The next pattern is a common reversal pattern, one of the important reversal patterns that forms at the end of uptrend. This pattern is identified when a red candlestick is formed with a jump and a gap higher than the previous candlestick under resistance. The goal in this pattern is also to trade on the third candle, and for the trade, it is better to have confirmation first. Look at this uptrend. A resistance has been reached, but the red candle has formed with a jump and a gap higher than the previous candle. Look at the distance between the close price of the green candle and the open price of the red candle. This is because of the jump in price upwards. But pay attention to this important point. The more the penetration of the red candlestick inside the green candlestick, the more valid and strong our pattern is. For the trade, our third candlestick must first receive pressure and rejection from the close price or shadow of the green candlestick, and then we can enter a lower trade, which is why this pattern is called the dark cloud cover pattern. But the last pattern in this video is the piercing pattern. This pattern is also a reversal pattern that forms at the end of a downtrend. Whenever at the end of a downtrend, a green candlestick is formed with a bounce and gap down compared to the previous red candle, we can enter a higher trade by receiving confirmation on the third candle. Look at this downtrend. At the end of the trend, the green candle is formed with a bounce and gap down. So, we can enter a trade on the third candle by receiving confirmation. That is, if our third candle receives pressure and rejection from the close price or the lower shadow of the first candle, we will enter a higher trade and there is a possibility of a trend reversal. Okay, let's go back to the pocket option. I will show you some examples of these patterns to better understand them. Okay, dear friends, in the next parts of trading with candlestick psychology, I will definitely trade by identifying these patterns so that the points in this video become clearer and easier for you. Be sure to watch other episodes of candlestick psychology on this channel and note down the important points and practice and trade on them. To support me, please subscribe to the channel, like the video and send the channel link to your friends. To register for PocketOption, use the links below the video. Click on the link, get a demo account of $50,000 and receive a 50 to 100% bonus for practice and trading. Don't forget, you are the best. Take care of yourself. Until the next video, bye.